We've got a very busy week coming up with a long list of corporate announcements set to write a lot of the headlines. But we also have the latest Bank of England policy statement to ponder. Governor Mark Carney will reveal the Monetary Policy Committee's latest decision on Thursday the 7th of November. At the moment, the Bank of England's two major policy tools stand as follows. The headline base interest rate is 0.75%. That's after increases of 1/4 point apiece in November 2017 and July 2018. Quantitative easing, well, that stands at £445 billion, made up of £435 billion of purchases of UK government gilts and £10 billion of corporate bonds. Now that figure's been broadly unchanged since August 2016. Governor Carney and his colleagues have been hinting for some time at their desire to push through further interest rate increases. This makes sense, given low levels of unemployment and wage growth that's outstripping inflation. However, the MPC's members have also cited Brexit-related uncertainty as a reason for not increasing the headline cost of borrowing. Throwing interest rate cuts from central banks in Europe and America, to name but two, and it's pretty hard to see the Bank of England raising rates, and a lot easier to see it shifting its stance towards making a case for cuts. No change in policy is expected in interest rates or QE, and the important bit may therefore lie in the vote. In September, the MPC voted 9-0 to leave interest rates and QE unchanged. Economists will be looking to see if anybody breaks ranks this time around. Back on the corporate front, there's plenty of scope for fireworks in the coming week. 10 members of the FTSE 100 are due to release full year or interim results or publish a trading statement, and a good number of mid and small caps are set to do the same. They include non-life insurer Hiscox on Monday the 4th of November. Then on Tuesday the 5th, we have Primark owner Associated British Foods, Imperial Brands, Flutter Entertainment, Wizz Air and Trainline. Then we get house builder Redrow on the 6th. Sainsbury, National Grid, RSA Insurance, Persimmon, Aston Martin Lagonda, Hikma Pharmaceutical and Auto Trader all come on the 7th. And then last but by no means least, British Airways parent company International Consolidated Airlines will report on Friday the 8th of November. But the company which could just cause the biggest fuss in the week ahead might be a company which actually fell out of the FTSE 100 for the first time in its history back in September, and that is Marks & Spencer. The High Street Bellwether is due to publish its first half results on Wednesday the 6th of November. Now, as we can see from this graphic here, Marks & Spencer's shares have fallen pretty hard over the past 12 months, and they've done so with grinding consistency, and that even allows for what looks like a bit of an attempted rally of late. Now, there are several possible reasons for this fairly depressing run, and they include a steady trickle of downgrade to profit forecasts from analysts, a dividend cut for the year to March 2019, with another one likely coming in for the year to March 2020, investor scepticism regarding the plan to buy 50% of Ocado's food delivery business for up to £750 million, a plan that was funded by what turned out to be a poorly received rights issue, priced at 185p, and that cut in the dividend. In sum, investors seem concerned that the pace of change under Chairman Archie Norman and Chief Executive Steve Rowe isn't fast enough, or at least that it isn't delivering the desired results, despite £1.4 billion in restructuring charges in the last 3 years alone. Now, those cost cuts underpin a 3-year plan to reduce costs by £350 million in the year to March 2021. Now, overall for this year to March 2020, M&S has forecast that UK operating costs will be flat to down by 1%, and that capital investment will come in between £350 and £400 million, a big increase on last year's £283 million. Besides those numbers, analysts and investors will look towards the sales trends at both food and the clothing and home business, since they've both been stuck in reverse gear for some considerable time. M&S stopped giving a first quarter update alongside its July annual general meeting a couple of years ago, so we only have the figures to March. But food sales have dropped year on year for 9 quarters in a row on a like-for-like basis, and clothing and home has, unfortunately, equalled that grim run. Note that M&S has already said that store closures will knock 1% off food sales and 3% off clothing and home. The company's also forecast a change in gross margin at both operations of plus 1/4 percentage point to minus 1/4 percentage point, so keep an eye out for any changes there. That combination then of revenues, gross margin shifts and cost cuts will get us to profits, logically enough. For the full year, analysts are looking for an adjusted pre-tax income of £465 million. That compares to £523 million a year ago, so that 11% drop could be a benchmark for the first half figure. And just so you know, a year ago, M&S made a first half adjusted pre-tax profit figure, excluding restructuring items, of £224 million. Finally, attention will turn to that dividend. M&S cut last year's final payment by 40% to 7.1 pence a share, enough to take the full year sum down 26% to 13.9p. Analysts are forecasting a reduction to around 10.8 pence a share for the whole year to March 2020, although do note, of course, now the share count's higher thanks to the June rights issue. Thank you for watching, and I look forward to seeing you next time.